Hello everyone. Today we'll take a look at the price dynamics in the market. How they actually go from one phase to another, and we'll explore price cycles and specifically the Wyckoff method. This particular Wyckoff price cycle has been around for so many years, like almost 100 years now. That there are so many books available on explaining what it is about, but it is very simple. The market, any stock or asset which is traded over the counter or in the exchanges, and they all go through some kind of price cycles. Price doesn't move in straight line. We all know that. As you see in the screen, the stock consolidates, moves up, consolidates, moves down, consolidates again, moves up. So, in short, Wyckoff gives names for four phases of for one cycle. So, the first phase is accumulation. So, when you look at accumulation, so accumulation is a phase in the Wyckoff price cycle in which informed investors accumulate shares of a particular asset. In our case, it could be a Bitcoin, a stock, or a commodity, anything. So, if traders understand and can detect what goes on into accumulation, so uh, these are the characteristics you can find in uh, the accumulation phase. So the stocks will have sideways price movement. So if you look around, take a deep dive into the phases, so it is moving sideways. No, so that is what it says. So it tests support levels. So if you draw support here, it will test that a couple of times, and also the resistance levels in many cases. And it will all see when you say test support levels and it bounces back, it means the selling pressure is being absorbed. And so so one of the things that you can notice is that the professionals do not want to leave a footprint for the retail investors. They do it very silently during the accumulation phase. Obviously, there would be volume spikes, and when the stock goes down, test the support levels, the volume would be a little lesser than during the spikes. So that goes on for quite a period of time, and in some cases, if it is a bear market, it would extend in time, but eventually it will break out. So that phase is what we call as the next phase. So that we look at that, and a lot of times these weak hands, they sell the stock to the strong hands who go on accumulating it. And so why do they do it actually? The institutions repeatedly they go on researching stocks. That's their business. Naturally, they have to do it anyways. So they know what's going on in the industry. So something comes up with a new plant, a capital expenditure, a patent, or anything, any changes in government policies. All of these informed decisions go into the accumulation phase, and they do not want to know accumulate big questions in one time, one shot. So they do this when the market is very silent, market is on sideways movement, so they can accumulate very easily without spiking the price. Now, what happens after they do accumulation? They actually spike it up in most cases. So that is called the markup phase, which is the second phase. So this is where the stock goes up. So this was a sudden spike, but now when it came down, there was so much accumulation again seen because it tested. This is a what do you call that? Sudden spike in prices, like price shocks or any something, some uh, major incident would have triggered this price. But again they went on accumulating. Then this is the price move which is seen in the market phase. So from 250, it almost doubled. Now, when you look at the markup phase, So there are certain things you can see. It is always in uptrend. It doesn't mean that it goes up in one straight line. There are actually pullbacks. And in some cases, the pullbacks are, it don't even come to these 20 period or 50 period moving averages. Like it just goes in big spikes. But in most cases, it would be very slow that you won't even notice it. The spikes are like extended over 12, 12 weeks, something like that. So that is the normal range, given that we now have a holding period of not more than 8 months. For the average holding period is somewhere around that. So higher highs and higher lows, like we know this price action. So the next time the stock comes down, it doesn't go below the previous lows, and whenever it goes up, it actually breaks the into new highs. So increased volume, which is like, the retail investors jump in and just go on accumulating during the phase. There are like so many concepts around which swing traders play the market. They buy it when it spikes, breaks out previous highs from a consolidation, and hold on for 3 weeks to 3 months. So that is when the volume actually goes up. And finally, after 30% or 60% move in a very short period of time, like the most important players or the smart money likes to liquidate their positions. So they can't do it like all of a sudden again, they will themselves, push the prices down. So during that phase, know, they distribute it. Now, when it comes to a markup phase, how do you trade it actually? So you can actually enter like buy trades. You can, like, whenever there is a pullback to the 20 period moving average, in our case it will be 20-day moving average, you can enter. Then again, if you are entering, it has to be a like strict stop loss, because you are entering in a stock which is like which has high momentum during that period of time. Like you can also use some patterns which we will see in separate videos, the ascending triangle, flag patterns, and consolidation breakouts. Like if you are considering the daily time frame, and when the stocks consolidate in the 1 hour period, then you can enter the breakouts from that congestion zone. So that's what it means. And one of the important things you can use is the Fibonacci retracements, which is again good for entries. So which is nothing but excuse me. So if you look at the next cycle here, uh, so sometimes after a spike, they also retrace. So you can draw this Fibonacci retracement, like you can see this, right? So normally when there is a spike, there is also retracement to this level. So these are the levels, like they have 0.6 or zero point 0.8. So you have to draw it upside down, of course. So there will be like whatever gains have been made during that period, there will be some retracement before it spikes again. So that you can use. Uh, so those are the things you can actually use to enter stock during the markup phase. Then you have this distribution phase, which is nothing but the big players want to exit the stock, but they do it very slowly. So they want to unload these shares to retail investors or uninformed investors, and they don't want to do it all in at once. So they will take their time. So it goes down, goes up, like they do it in a very silent way. And finally, like when they are done with that, uh, the, there is no absorption of sell-offs. So the prices go down. Now, how do we actually identify distribution? It will be mostly sideways to slight uptrend and decreasing volume. If you see this phase, there has been a significant decrease in volume and signs of weakness, which means the previous high won't be broken, and it will test the resistance levels 1 or 2 times, but it won't actually pierce and go up. So how do we trade? Actually, we don't like you can. use some option selling strategies that profit from sideways movement. That is one of the things you can do. But there is also one thing you can look out for, if the previous high, when, so if this stock has broken out this high comfortably after a period of time, let's say 1 or 2 months, then the market actually, this rally is getting extended. So that you can use to enter new position, because when you have a extended bull market like the one we have in Nifty in 2000, starting 2023, now we, like every time somebody says the Nifty is going to correction, it actually comfortably makes new highs. And most of the stocks, like our PSU stocks, for example, the Punjab National Bank, or any, for that matter, any financial institution or public sector unit has, even after a brief, distribution phase, still they are going up. So if it is not falling and if it is taking out previous highs, then you can enter. And the final phase is the markdown phase. So the markdown phase is like, you can use so many things like head and shoulder patterns, so many other things where, it breaks, one final day it breaks and then pulls back and then breaks down again. So how do we direct it? Actually, it will be a downtrend, which means that the previous highs will not be broken, and every single time a new downtrend is formed, I mean, a lower low is formed. That is downtrend, right? So potential selling climaxes, which means that, in 2 3 days the stock will lose, like, 30 40% of their gains in just, 2 3 sessions. And if the markets are also bearish and the sentiment is not that great in the market, then it can break very all of a sudden, and lower highs and lower lows. That's downtrend or price action. So that's something like you have to understand. We'll look at those things in separate videos. Uh, how do we trade? No, there are ways to trade markdown phase. Shorting shares intraday. So every single day you can do some intraday trading, which is not a game for all of us. Like, you have to actually be very careful. You have to understand technical analysis. You have to have a proper risk management in place. So then you can do that. But, buying naked put options is another way to play out this, phase. And then you can use employ, uh, various option strategies, like whenever there is a pullback into the resistance zone, then you can do that actually. So those are the ways you can do trade the mark down phase, which is the last phase. And after a climax of selling is reached, which normally happens around this support region, the previous support region. So yeah, then it will actually hover around that and a new trend emerges if the stock is really good. Then, I mean, the stock has to be good, right, for the next cycle to even happen. So, like, this is all about the Wyckoff price cycles. So how do we use it? We can actually see some examples in Indian markets, because if it all is history, then we won't be able to put to proper use, right? So we will look at some stocks which are actually in different phases now. So let me pull some which I have noted down. So when there is an accumulation phase, this is how it happens actually. So this is one accumulation. Now we are seeing another phase of accumulation. Now this can also be called distribution. Why it is not distribution? Because it has tested the resistance 4 5 times and it has never fallen, below the previous lows. That means, like, the stock has still a lot of steam left, and it can test new highs quite, soon. And this is also something. There was a, accumulation period, then the spike, and here I don't see any, indication of distribution right now. There may be another leg of spike before it, reaches the climax. So these are the stocks I am considering right now, and this is one stock. Now, which could actually consolidate for a period of time, then move up. And yeah, this is our third example, VLS finance. These are examples which are like picked from the present market conditions. Okay, so then this is something which has moved up recently. There was a accumulation spike, then there was then it is like it is still a lot of volume, like so, which means that there is still a lot of buying in this counter. The results are coming up soon. So Monday we have the results. I don't know like what will happen then. Yeah, let's see what happens. If there is a surprise, I personally hold some shares of LIC right now. So yeah, those are the stocks which are in the consolidation phase, I mean, or the accumulation phase, and the second leg of accumulation, you can say. And yeah, we will come up with another video tomorrow for the stocks which can be kept in watch list in the coming weeks. Stay healthy, stay happy. Let's meet in another video. And if you like, comment and subscribe. Thank you very much.